So the third quarter was quite eventful from a macro perspective. You had the US Federal Reserve cut rates, which was highly anticipated by the market. And towards the end of the quarter, you had rumblings from the Chinese authorities in regards to fiscal stimulus, which got resource stocks quite excited. Apart from that, you had the continued upward rise of the Aussie banks, which have so far defied gravity. So the drivers of the performance over the quarter was driven by key fund holdings such as AGL, Fisher & Paykel and Brambles. So all three actually benefited quite well during reporting season where they reported very solid results. They're both all three actually move very differently for different reasons. Brambles actually accelerated higher due to the fact that the market has recalibrated its expectations that the company can actually generate more free cash flow than in the past. And Fisher & Paykel came out with a profit upgrade, and AGL just came out with very solid numbers. Apart from that, our underweight positions, such as in the banks and also to a certain extent resources, have dragged on our relative performance over the quarter. So one new name added to the portfolio is Auckland Airport. So during the quarter, Auckland Airport performed a major equity raising to actually shore up its balance sheet. Now, this equity raising from our point of view is not such a bad thing. There's two types of equity raisings. One is falling earnings and they desperately need capital to inject into the business. This one for Auckland is actually more related to their CapEx plan. So earnings aren't collapsing, it's actually they need the extra capital to actually grow their business. And because it's a regulated entity, they'll receive a certain return from that CapEx plan. So we actually participated in the equity raising and built up a sizable position. Some of the names that were removed or reduced was our gold holdings. So given the strength of our gold stocks in terms of their performance, we've just trimmed our holdings. We still have positions in the space. And one stock that we have removed is Steadfast. So Steadfast was caught up in the Four Corners episode that highlighted some inconsistencies that the regulators have highlighted. And there's one thing for certain, when it comes to the stock market, when there's uncertainty in regard to the regulatory environment, it will take a while for these companies to perform well. So we've removed it and allocated the capital elsewhere. Yeah, so the Australian stock market has defied gravity, pretty much driven by the Aussie banks. So if you look at the earnings growth profile for the Aussie market, it's been pretty lackluster. It's actually quite flat. Due to the fact that there's hardly any earnings growth from the banking sector. There's also hardly any earnings growth from the commodity sector. So the challenges in China obviously has a big impact on the health of the commodity companies in terms of their profits. Now, if China does follow through with proper stimulus, we should see a pickup in earnings associated with the commodity stocks, and hopefully that can support the stock market elevated valuations currently. Yeah, so right now the Australian market is trading on a P of 18 times. To put that into context, the market wasn't that long ago during the COVID crisis rallied through 18 and touched 19 times. So it's actually not far off from the COVID bubble that we experienced 3-4 years ago. Never in the last 20 years have we seen the valuation so stretched. The difference now between COVID was that at least from the market lows, when earnings was recovering, the market was anticipating that recovery, and it did come through. Right now, we have very stretched valuations on very subdued earnings growth, right? So you don't have the same catalyst from a strong rebound in earnings. So with that backdrop, you would expect greater volatility to impact our market unless we have supporting earnings, which is unlikely in the current environment.